Good morning, good afternoon, good evening, everyone, and welcome to our top trade for March 2020, coming from the top 30 U.S. equities pairs. And what a month it's been. March has been incredibly volatile, as I'm sure you're all aware, and that has created some extraordinary opportunities in stock pair trading as well as within our own top 30. The trade we're going to nominate now as the trade of the month for March 2020 is for the pair CAR-URI. And that trading signal came in on the 18th of March to buy long CAR and sell short URI at negative 3.35 standard deviations. Okay, well, what are these companies? CAR is Avis Budget Group, which I'm sure a lot of you are aware of or know of, having seen rental cars at every airport around the world. And URI is United Rentals Inc. Avis is 1387 last close on NASDAQ, URI 107.93 last close on NYSE. And as a demonstration of the volatility we've seen in March, when we put this new pair into our latest top 30, which were launched on March 1st and using 63-day lookbacks, so they're faster pairs, about 10 to 20 days average trade duration, the market cap was over 3 billion, and now it's at 964 million. United Rentals is at 8 billion market cap, so these used to be much more closely matched. The beta on both companies is 2.3. And Avis is in industrial sector, industry subsector, rental and leasing services, and has about 21,000 employees. It's in New Jersey, United States. And what do? They provide car and truck rentals, car sharing, and ancillary services to businesses and consumers. United Rentals is also based in the United States in Stamford, Connecticut. It's got 19,100 employees. It's also in the industrial sector, also in the rental and leasing services subsector. So what does it do? Well, instead of renting cars and trucks to businesses and consumers, it rents all types of sort of heavy equipment like backhoes, skid steer loaders, forklifts, earth-moving equipment, and all the ancillary equipment and services around those. And it rents those primarily to businesses. So they are very fundamentally similar businesses, being in the same industry subsector, both renting vehicles to somewhat different consumer versus business customer sets. So why did we choose them? That's the fundamental correlation that we've identified. And then we looked at them in backtests. So over the last 3 years, there were 5 trades, 63% average correlation. The co-integration when this pair was chosen was over 0.90, so it was co-integrated. It's dropped slightly to 0.80, so something you need to keep in mind for future trades. The compound annual growth rate of capital allocated without leverage would have been 13%, and the max drawdown 11.48%. Most importantly, besides the $4,700 of gross profit it delivered over those 3 years in backtest, was there are 100% winning trades and at over $906 average net profit a trade. And importantly, its average days in trade is about 10.8. If we go to the chart on the bottom left here, you'll see this is the equity curve of the pair over the 3 years, and here you'll see the 5 trades, all of them winners. Only one significant drawdown here in the last trade, but it quickly came good. We then look at the ratio chart in the bottom right, and what we see here is this is a great ratio chart for pair trading for this pair. You've got the blue line is the moving average of the ratio, 63-day look back. The green line is the daily measurement of the ratio, and you see lots of zero crossings back and forth over the moving average on both the positive side and on the negative side. So that's exactly what we want to see in a ratio chart. So on that basis, that's why we selected the pair. Now we had the signal on the 18th of March. First thing you would do is check news. So let's do that. And if we check news, we see that for Avis, there's been no significant news in the market regarding this company since February 19th when they announced their quarterly record results in the US, and this signal was on the 18th of March, so that was almost a month later, and therefore there's nothing that would have affected it. There is an update on March 23rd, but that was 5 days after the trade signal, so it was clear. Then if we go to United Rentals, you can see the last significant news was on February 10th, where they talked about the closing of a senior notes offering, and then previous to that, January 29th, when they reported full year results. These two Announcements were just conference attending, and the last one was February 25th anyway. So there's no significant news on either company, which means we're looking at a liquidity-driven signal, which is what we love to see. Before we would clear it to trade and further analysis, we would just quickly look at what are the dividend dates and what are the earnings dates. Neither of these are paying dividend right now, so we don't have to worry about that. And the next earning dates on both are April 28th, 2020, and we're looking at a trade signal on March 18th that has an average days in trade of 11. So we have over 40 days to go until the next earnings announcement. Plenty of time. So this pair ticks all the boxes to go to further review of the pair charts. Before we do that, we just quickly look at the share price charts. What we'll see for Avis is it hit a maximum on the 20th of Feb, then with the market crash went all the way down, and the last day was 18th March, where it called the signal, was its lowest. It was the nadir of the share price. Same thing with United Rentals, also ranging for most of the year. It had its high at the end of the year, and then again its nadir on the 18th of March at the end of that market crash period. So why the trade signal then? Well, here's a relative share performance of CAR URI, and you can see here's the plunge with the market crash. Avis had outperformed to the upside and crashed way further than URI. It's got higher leverage, and this is where the trade was called right here. So there was a relative underperformance of Avis CAR versus United Rentals, and that's what made the trade signal call. What we can see here over the last year is every time these pairs have diverged on a relative performance basis, they've converged. So diverged, converged, diverged all the way along here, reconverged here, it's diverging, and we're playing on a reconvergence. So on the basis of this relative performance graph, it looks very good to trade as well. So that means we've got a clear signal. We go to the pair charts, and here you can see the signal, negative 3.35 standard deviations. Is that way out of line? Well, we had two other signals this year at over 3 standard deviations on the positive side. So based on the scale of the move in a standard deviation measure, it doesn't seem excessive. So we would say good, that it's at one of its extremes, but not out of a normal range. Then we'd look for percent from mean, and we can see that the previous signal was all at plus 8% from the mean. This one is at negative 10%. So these are pretty substantial movements versus the mean. If we look at historically over the rest of the year, it wasn't as far. You're looking at more like 3 to 4%. But given the unprecedented volatility, we're obviously going to see bigger moves. You might want to look at this over the last 3 years to see whether in the past there had been similar size moves. But prima facie, and given the volatility in the market, we would say there was plus 8 on the upside and minus 10 on the downside. It's something we could probably live with. We would look more closely now at the RSI chart and the ratio chart, and we can see that there's slightly trending down ratio. Big move on the upside, which produced a profitable trade before this one, and then a big move on the downside. These are arguably both out of the previous range over the last year. You would again want to go back 3 years, see if you saw anything that equated this range. But you also want to take into account we're dealing with extreme volatility, and you might see wider ranges. Up to you to decide whether it's too crazy out there and you don't want to trade, or whether you're willing to take on that extra volatility and say, I'm still going to play. Now, what we do like here is we have a lower low here and a lower low here on the ratio. And on our RSI, first off, it's at a very extreme reading down to about 5. But on this lower low, we have a reading at 5. And on this lower low, the next 3 days later on the ratio, we have a higher low on the RSI. Now that's divergence. So when we see divergence like that, this is going down, this is going up. That increases the probability that we may see a reversion to mean, and we like to see that. So our trading plan includes that. This would give us a big check, and we would get more confident on this trade. So the two other things you might want to check before you decide to definitively take the trade. One is volatility, and here we see this is at 3.40% volatility. An average, a standard pair would be somewhere between 1 and 2 or 1 and 2.5. And when we get over 3, we like to position size a bit lower. So we'd probably take this at about 7,500 a leg, or 3/4 size. Anything over 4, we would probably take at half size. And anything over 5, we probably wouldn't take as being too volatile. So on this one, there's a bit of a warning sign here. You would take it with a lower position size. Okay, the other thing is on the last 63 days, correlation is strong here at 85%. So we're about 3 weeks later. So you'd have to have looked at this at the time of the trade, but you want to see that correlation, even if it's broken down, it should be on its way back up. Is something else you can check, and that's positive. So we would have taken this trade. Had you done so, what happened? Well, the exit signal happened 23rd of March. 3 trading days later, let's look at that in the pair charts trade history. So you had gone long at 778 Avis, and you sold out of that position at 1340 3 days later, making almost 80 or 90% on that long leg. On the short leg, you'd shorted at 69.59. You would have covered that short at 70.89 and lost a little bit of money on the short leg, but more than made up for it on the long leg. The net result of the trade, 6,982.90 after commissions and slippage. And were you to be trading on a CFD account at 5-to-1 leverage, you would have had to deploy $4,000 of margin to hold this trade, and you would have made $6,983 on that $4,000 of margin in 3 trading days. So an extraordinary trade, extraordinary profitability, and something we just wanted to highlight that can happen in the markets and with these top 30 U.S. equities pairs. So happy trading, everyone.